हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 110, दैट इज कंसोलिडेशन ऑफ अकाउंट्स पार्ट 10। सो लेट्स स्टार्ट आवर टॉपिक।
Illustration 1. A Limited, a parent company, sold goods costing rupees 200 lakhs to its subsidiary B Limited, holding 80% stake in at rupees 240 lakhs. 50% of these goods are lying at its stock. 50% of these goods are lying at its stock. B Limited has measured this inventory at cost, that is at rupees 120 lakhs. So the necessary journal entries in the consolidated financial statement assuming 30% tax rate. So this is a downstream transaction where parent sell goods to the subsidiary. This is a downstream intra-group transaction. Parent A Limited sell goods to subsidiary B Limited. Relevant rule under Ind AS 110. Any unrealized profits included in the inventories, that is the closing inventory, must be eliminated in the consolidated financial statement. So whatever the unrealized profits are included in closing inventory at the time of preparation of CFS, we have to eliminate. This is the intra-group transaction. So cost of goods sold, that is 200 lakhs. A Limited का costing 200 lakhs है, जो कि A Limited ने sell किया to B Limited at 240 lakhs. So A Limited recognize a profit of 40 lakhs. Ownership of A Limited in subsidiaries books is 80% and goods remain lying in the stock of B Limited is 50%. Tax rate becomes 30%. Now how to calculate the unrealized profits? Profit margin is, so selling price minus cost, that is 40 lakhs is the profit for A Limited, out of which 50% is remain lying in the stock. Closing inventories in the B books becomes 240 into 50%, so it becomes 120 lakhs. Profit percentage on selling price, 40 lakhs is the profit made by A Limited. Selling price of A Limited becomes 240, so 1/6 of the is the percentage of the profits on the selling price. Unrealized profits in the closing stock becomes 50%, that is the closing stock become 120 lakhs. Profit percentage on selling price become 1/6. 20 lakhs is the profit which is unrealized in the closing stock. Deferred tax adjustment, since profit is eliminated in CFS, tax has already been paid. Profit is eliminated but tax has already been paid, so it creates a deferred tax asset. So deferred tax asset arises. DTA becomes 20 lakhs or 30% becomes 6 lakhs. Consolidated adjust. Firstly, we will eliminate the unrealized profits by passing a journal entry through retained earning account debit to inventory. We will reduce retained earning by 20 lakhs and also reduce the inventory by 20 lakhs. So inventory is reduced to the cost to the group.
Recognize deferred tax asset, that is deferred tax asset account debit by 6 lakhs to retain earning 6 lakhs. Effect on NCI, that is since it's a downstream transaction, that is parent sold goods to the subsidiaries. In this case, parent recognize the profits because parent sold goods to the subsidiary. Adjustment affects only parent's profit. NCI is not affected.
So final effects in CFS, inventory goes down by 20 lakhs, parent profit goes down by 20 lakhs, deferred tax assets create 6 lakhs, net impact on group profits become, profit is 20 lakhs, out of which we had created a deferred tax 6 lakhs, so profit is reduced, net effects of group profit becomes 14 lakhs. So NCI no effects. Unrealized profit of 20 lakhs included in subsidiaries closing inventory must be eliminated. Deferred tax asset of 6 lakhs is recognized due to temporary difference. Now illustration 2. Ram Limited, a parent company, purchased goods costing rupees 100 lakhs from its subsidiary that is holding 80% stake of Sham Limited. Ram Limited is a parent company, purchased goods costing rupees 100 lakhs from its 80% subsidiary Sham Limited at rupees 120 lakhs. 50% of these goods are lying at the godown. Ram Limited has measured the inventory at cost at rupees 60 lakhs. So the necessary adjustments in the consolidated financial statement assuming 30% tax. The solution, these transactions where Ram Limited is a parent company who purchased goods from its subsidiary Sham Limited, where Ram Limited holding 80% stake in Sham Limited and purchased goods from Sham Limited at rupees 120 lakhs whose costing is 100 lakhs, where 50% of the goods are lying in the godown. Ram Limited had measured the inventory at cost, that is 60 lakhs. In this case, what happened is a upstream transaction where subsidiary is selling goods to the parent. This transaction is an upstream transaction because subsidiary Sham Limited sell goods to the parent Ram Limited. Relevant principles under Ind AS 110 apply. Unrealized profits included included in the closing inventory must be eliminated in the consolidated financials. Now, particulars: cost to Sham Limited becomes 100 lakhs. Selling price becomes 120 lakhs. Profit made by subsidiary of 20 lakhs. 100 lakhs is the cost to the Sham Limited and it sold that inventory to Ram Limited at rupees 120 lakhs. Profit made by Sham Limited is 20 lakhs. Parent holding in this case is 80%. Remaining is held by NCI, that is 20%. Goods remain, closing stock becomes 50%. Out of 120 lakhs, 60 lakhs are still lying in the stock in the books of parent company. We have calculated the unrealized profit. Profit margin becomes 120 minus 100, it becomes 20 lakhs. That is the closing inventories in the parent book becomes 60 lakhs. Unrealized profits, how much unrealized profits in the closing inventory? That is 60 lakhs inventory पड़ा हुआ, उसमें से 20 lakhs का profit divided by selling price, that profit divided by selling price into closing stock, so it becomes 10 lakhs. 10 lakhs is the unrealized profit. That unrealized profit is to be eliminated from inventory and also from retained earning. Deferred tax adjustments, since the profit is eliminated in CFS but tax has already been paid, so deferred tax arises. Deferred tax asset will arise. 10 lakhs into 30%, it becomes 3 lakhs. DTA arises 3 lakhs ka. How you will pass the consolidated journal entry? Eliminate unrealized profit. How you will eliminate? That is retained earning account debit, subsidiaries PL account debit by 10 lakhs to inventory 10 lakhs. Inventory is reduced to cost to the group. Recognize deferred tax asset.
Deferred tax asset account debit by 3 lakhs to retained earning 3 lakhs. Now impact on parent and NCI. Since this is an upstream transaction, that is subsidiary sold goods to the parent, elimination affects both parent and NCI. In this case, who will recognize the profit? Subsidiary. So subsidiaries profits may parent and NCI both are liable. So in this case, particulars: unrealized profit becomes 10 lakhs. Parent share is 80%, so it becomes 10 lakhs ka 80%, it becomes 8 lakhs. NCI share is 20%, that is 10 lakhs ka 20%, it becomes 2 lakhs. Effect on deferred tax, that is DTA. DTA becomes 3 lakhs. So in this case, 3 lakhs is recognized here. It depends on the 30% of 10 lakhs, that is 3 lakhs. In deferred tax asset, parent share is 80%, that is 3 lakhs ka 80%, it becomes 2.4 lakhs. And NCI share becomes 3 lakhs ka 20%, it becomes 0.6 lakhs. Now final effects in CFS, that is inventory goes down by 10 lakhs. Deferred tax asset is recognized in the balance sheet, so it goes up by 3 lakhs. Impact becomes, because 8 lakhs is the parent's profit, deferred tax asset is recognized separately, so we have to reduce parent's profit. Parent's profit is 8 lakhs, उसमें से deferred tax asset, that is parent share is 3 lakhs का 80%, 2.4 lakhs, it should be reduced, so it becomes 5.6 lakhs. So remaining profits of parent becomes 5.6 lakhs and NCI profits becomes 2 lakhs में से 0.6 lakhs is to be reduced, so it becomes 1.4 lakhs. Conclusion: unrealized profits of 10 lakhs included in the closing inventory must be eliminated. Deferred tax of 3 lakhs is to be recognized, and since it is an upstream transaction, both parent and NCIs are affected. Now illustration 3. A Limited, which is involved in the business of selling capital equipment, parent company sold a capital equipment costing rupees 100 lakhs to its subsidiary B Limited at rupees 120 lakhs. Capital equipment is recorded as PPE by B Limited. The useful life of PPE on the date of transfer was 10 years. Show the adjustments in the consolidated financial statement. Solution: this is an intra-group sale of PPE. Seller A Limited, that is parent company. Buyer B Limited, that is subsidiary. Parent holding is 80%. Cost of PPE to the parent is 100 lakhs. Selling price to the subsidiary is 120 lakhs. Profit recorded by the parent is 120 minus 100, that is 20 lakhs. Remaining useful life is 10 years. According to the Ind AS 110, intra-group profit on sale of non-current assets must be eliminated because the group is treated as one economic entity. Now nature of transaction. This transaction is a downstream transaction. Why? A parent company sold goods to the subsidiaries. Therefore, adjustment affects only parent's profit. NCI is not affected in this case. NCI profit is not affected. Unrealized profit becomes profit recorded by the parent is 120 because who sell goods? Parents sell goods. In whose books profit is to be recorded? That is parent's book. Profit recorded by parent is 20 lakhs. That is 120 120 minus 100, it becomes 20 lakhs. These 20 lakhs is unrealized from the group perspective. PP is still lying in the books of subsidiaries. B Limited record asset at rupees 120 lakhs but group costing is 100 lakhs. Depreciation difference per year becomes depreciation in B's book, that is subsidiary books. Cost for B Limited is 120 lakh divided by the useful life, that is 12 lakh. 12 lakh is to be recorded in the B's book. Depreciation as per group perspective, because the profit is eliminated while consolidating, 100 divided by 10, so it becomes 10 lakhs. So excess depreciation already charged, we have to remove that. That is 12 minus 10, that is 2 lakhs. Unrealized profits, that is retained earning account debit 20 lakhs, that is from the parent's book to PPE, that is 20 lakhs. Adjust excess depreciation, that is PPE account debit 2 lakhs to depreciation expenses 2 lakhs. This is the reversal of extra depreciation charged by the subsidiary. Now deferred tax asset 30% tax rate, temporary difference 20 lakhs because the selling price is 120 and cost is 100, so temporary difference recognized, that is 20 lakh. Tax rate is 30%, 20 lakh into 30% becomes 6 lakh. Tax is paid extra, so deferred tax asset is to be recognized. Deferred tax asset account debit by 6 lakhs to retain earning 6 lakhs. Annual reversal of DTA, each year temporary difference reduced by 2 lakhs. So reversal of depreciation becomes tax expenses account debit by 0.6 lakhs to deferred tax asset 0.6 lakhs. Meaning deferred tax asset decrease because benefit is being used. Tax expenses increase since earlier benefit is reversal. At the time of sale you save tax, that is DTA is created, deferred tax asset is to be created. Over time that benefit get consumed gradually through higher depreciation. So initially temporary difference becomes 20 lakh and DTA is to be recognized 6 lakh while consolidating. After 1 year the temporary difference becomes 18 lakh and DTA becomes get reduced by 60,000, that is 0.6, so it becomes 5.4 lakh. After 2 years it becomes 16 lakh, temporary difference becomes, and it reduced 5.4 minus 0.6, so it becomes 4.8 lakh. It represents systematic reversal of DTA, that is deferred tax assets, reversal of DTA. Net effects in CFS, PPE becomes, at the time when consolidation is prepared, we have to reverse the profits lying in the stock. 20 lakhs is to be reversed. In that depreciation becomes 2 lakhs, 18 lakhs is to be the PPE adjustment. Depreciation expenses get reduced by 2 lakhs. Deferred tax asset created by 6 lakhs. Parents profit affected, that is 18 lakhs minus 6 lakhs, because this is the downstream transaction, so NCI is not affected. Whole effect goes to parents profit. NCI no effect. Conclusion, unrealized profits of 20 lakhs eliminated. Excess depreciation of 2 lakhs get reversed. Deferred tax asset 6 lakhs get recognized. Since it's a downstream transaction, NCI is not affected. Thanking you for watching my video. If you like, please share, subscribe my channel.